webinar from Meirc's free webinar series. Today we'll be talking about how to calculate the total cost of ownership, commonly abbreviated as TCO. So this is a live webinar, of course, and as we go along, you might have some questions. So if you do, please drop those down in the chat box you see in front of you, and we'll spend time towards the end of the webinar to go over those questions. So the webinar today will be delivered in 3 short parts. First, we define TCO, so what is the total cost of ownership? We then go over why TCO should be used before finally tackling the all-important question, which we're all here for, which is obviously, how is TCO calculated? This third part will cover the bulk of the webinar, and here I'm going to provide a scenario or practical exercise, essentially, and I'll be providing a step-by-step walkthrough of how the TCO is derived. So yes, we will get to a level of detail that's sufficient to help you calculate TCO for the acquisition of an asset you may be planning to invest in, be it a personal investment or be it one that you are planning at work on behalf of your company, especially if you're involved in your organization's supply chain department, procurement department, or maybe even contracting. Part 1 then, and what is TCO? So by definition, the total cost of ownership, or TCO, is going to be the sum of all direct and indirect costs associated with buying and owning an asset, minus or plus its salvage value at the time of sales down the line. So for instance, if you're looking to invest in, say, a car or any other asset, it's not going to suffice for the, if you want to be a savvy investor, you can't just look at the acquisition price or the buying price of that vehicle, which would amount to, say, a $20,000 bill, but we would actually want to know how much that car is going to cost us over the entire period that we expect to own that car, from purchase date all the way to disposal, say 5 or 6 years down the line. What we call the life cycle costs. That is specifically, why when buying a car, most of us don't just look at the price of the car, right? We also inquire about the servicing costs, fuel consumption per mile or kilometer. We even ask about the resale value of the car. And all of these costs, essentially, when they come together, are going to help us derive the total cost of ownership. So why is it important then to know our life cycle costs that we're talking about, or the TCO? Well, put simply, we want to know what we are getting into upfront anytime you make an investment. A lot of the time, we make an investment thinking we are, we have our hands on a gold mine. Moving forward, we know what we paid for today for that investment, but having not done our homework, a lot of us fall into that trap where we start getting hit with one unplanned expense or unexpected expense after the other. What I like to call bills from the blue. You're sitting there and you're being hit with different bills associated with that investment. So a $20,000 car may end up costing you another $20,000 or even $30,000 just in running expenses over the 5 years you own and operate that car. These are the costs, incurred from fees as maintenance, servicing, spare parts, fuel, etc. Before we know it, a $20,000 investment can go all the way up to $40,000 or $45,000. And if we are on a budget, or if we had planned on making a profit from that investment, such as renting the asset out or the car out in this case, or even if we've purchased that car thinking we could save some money on public transportation or on an alternative investment option, we may suddenly find that our expenses far exceed our benchmark that we set ourselves. And instead of the gold mine, we find that we are suddenly stuck with, yes, the white elephant. A white elephant, of course, defined as a bad investment that is expensive to maintain and difficult to offload cheaply. So then, the dollar amount that we pay when we buy an asset, what we are calling the acquisition cost here, turns out is just the tip of a very big iceberg. If we look deeper, we're going to find that operational costs, or those expenses required to run your asset, start piling up, such as costs for fuel or the driver if we're buying a car, or maybe salaries of engineers and other staff if we're actually operating let's say a new plant or a new factory. Add to those the maintenance costs involved in upkeeping the integrity of the asset, the logistical costs, such as those costs to purchase spare parts and the cost of servicing those spare parts like storage, maintenance of the spare parts. Suddenly, all of these costs start, we start to feel the weight of the full iceberg, which now is going to come in and show itself in all its glory. The tip of the iceberg was, of course, here the purchase cost. The full iceberg that we see in front of us right now, this is going to be the total cost of ownership that we are here to calculate today. Having that full view, of course, is going to help us decide if our investment is a sound one, worthwhile, and whether we should actually pursue it or not. How TCO is calculated then? So let us turn our attention to the third part of the webinar, which is going to be the largest chunk here, actually. So in short, TCO is going to be the acquisition cost or the purchasing cost of the asset plus the total service costs we expect to incur over the asset's life, plus or minus the salvage value, okay, which is the cost you pay or incur at the end of the asset's life. If we expect to sell the asset at the end of its life, which will generate a net positive cash inflow, then we are going to subtract the salvage value. So the equation becomes TCO is equal to acquisition costs plus total service costs minus salvage value. If, on the other hand, we have to pay money to dispose of the asset, such as dismantling charges, then that salvage value will have to be added to the equation. So the equation in this case becomes acquisition cost plus total service costs plus salvage value. Now, the total service costs in this equation, these are going to represent the operational, maintenance, and logistical costs, all of which featured earlier in our iceberg over there. An important note here, TCO is always calculated at present value. So since money depreciates in value over time, we will need to account for how much an expense incurred in the future actually represents in today's dollars. So for example, if you pay me $100 in 10 years time, that same $100 may only be worth $80 or $85 to me. Similarly, whatever $80 can buy you at the mall today, you may find that you need $100 or even more to buy that same exact thing that costs you $80 today is going to cost you, say, $100 in 10 years. Now, the present value of money can be calculated using the present value table that you see in front of you over here, or using one of many online NPV calculators, that's net present value calculators available today online. We will talk more about how this table is used in a little while. For now, let's just take a practical example of how TCO is calculated. So we can go through this case on a step-by-step basis, so we all have a practical understanding of how to calculate TCO for any investment that you may be planning yourselves. So here's the example. Say we are planning to invest in a small recycling plant. Okay, now that plant will cost me $35 million to acquire on day one. That's the original bill I am paying. The plant can be sold for $10 million, okay, which is the salvage value in 6 years, and the discount rate is set at 4%. So I buy the plant for 35, I use it, it depreciates in value, and then I can sell it for 10 million in 6 years. The discount rate, typically you can get, from your finance department. Now this varies from market to market. Usually it's set at 4%, and this is the value by which money is depreciating year on year. Again, we have various service costs associated with this investment that apply over the 6 years. So first, you see in front of you, we have the operational costs, and then these account to $150,000 for every day that the factory is operational or running. So for example, if I have a shutdown, if the factory is not operating, in that case, we are not going to incur these direct costs. We also have maintenance costs. So here we expect to have 4 types of maintenance, each with a different frequency, a different cost, and a different shutdown period. So for example, we start off here with the preventative maintenance cost over here. So we expect to be paying $40,000 every 2 months. And this 2 months is going to yield a 2-day shutdown as well, equivalent. So for 2 days, I will not be charged the $150,000 indirect costs over here. Routine overall, so again, you have $100,000 that has to be done once a year. So this is a bigger scope. 6 days shutdown equivalent, periodic overall $250,000. We're going to say this is going to be planned for one time only in year 3, and this is the largest maintenance, 14 days shutdown. You should also plan for corrective or breakdown maintenance. So we've budgeted here for $150,000 every 2 years, and this is going to yield 10 days of shutdown per operation. Logistics, let's keep this simple. So let's say the logistical cost will come down to $1 million per year. That is the $700,000 in annual cost of spare parts plus the $300,000 to service or store and maintain those spare parts. So let us first tackle the top half of this equation or the exercise. Remember our formula, TCO is equal to acquisition cost plus total service costs. In this case, because we have a salvage value that we're going to cash in, so the equation is going to be a minus salvage value over here. So instead of the plus, we're going to go for the minus. Straight up, let's going to plug in the $35 million as it is. This is the price we are paying for the factory on day 1. So that is, of course, the easy part. Next, we are going to register the salvage value. Now notice, we're not going for the $10 million here, but rather we are going to log it as $7,599,000. Now why is that? Because we expect this factory to run for 6 years, and we are planning to sell it or planning on selling it in year 7. So the $10 million you expect to cash in 7 years from today is actually worth a lot less than the $10 million are worth today. How much less? Well, we're going to multiply that figure by 0.7599, which is 10 million discounted at 4% over 7 years. So coming back to our net present value table, what we need to do is we need to find the point at which the 4% on the x-axis and the 7 years at the y-axis intersect. So 4%, which is our discount rate, and we're saying we're expecting this cash flow in 7 years. So that's why we're looking at where those numbers intersect. So 0.7599, which is the number we've used to multiply the $10 million with. Next, let us attempt to calculate the 3 components of the total service costs. Okay, we are going to make an important assumption here, which is that operational costs again are only incurred on the days that the factory is operational. If we have a shutdown situation or maintenance situation, such as the one due from any sort of maintenance, then no operational costs will be incurred on that day. Some overheads may still apply in reality, but let us assume for this example that these are insignificant, so we will not take those into consideration for this exercise. Now, to help us calculate the total service costs, we're going to be using 2 tables over here. The first table, table number 1, the maintenance shutdown in number of days, will help us calculate the number of operational days and the shutdown days, so that when we get to calculating the operational costs, we can multiply that $150,000 per day by the number of operational days that we have calculated. And the second table, which is table 2, total service costs. This one is going to help us understand the total costs incurred per year, so that when we come to apply the discount rate, we can do that by year. Remember, the value of money will continue to depreciate year on year, and this will need to be accounted for. So once we go back to the present value table, in year 1, we're going to multiply the 4% with the 1 year. Year 2, we'll take the 4% where that intersects with year 2, etc. We'll illustrate this in a minute. Now let's get straight to table 1 then, which is maintenance shutdown, as shown in a number as a number of days, where we will be logging the number of maintenance days per year. Now, from the original problem, we have calculated that we are going to feature 12 days, or we're going to have 12 shutdown days from preventative maintenance, based on the schedule that we have. We have 6 days of routine overall. There's no periodic overall, and there's no corrective maintenance in year 1. We've also planned for 18 days shutdown years. So if you multiply 12 and 6 and 18, and if you deduct that from 365 days per year, you are going to get to a grand total of 347 operational days per year. Year 2 is practically the same, but we're just adding another 10 days of shutdown for corrective maintenance. We've budgeted for that, remember? So that brings our total operational days per year to 337. We're going to go ahead and do the same for the remaining years, and this is what the picture is going to look like once we budget for all maintenance and shutdown operations. Now, let's take this figure here, the 347 days that I've just highlighted. We are going to carry this figure through to the next table to help us calculate the operational costs. So that's the table we are going to be using. And of course, the columns are operational costs plus maintenance costs plus logistical costs. And these three costs are going to give us the total service costs, which is the number we are looking for. And the last column on the right, the NPV at 4%, we are going to discount the total service costs by multiplying that with the appropriate NPV. So let's see how this is actually done. So first of all, the 347 days from the previous table, these are 347 operating days times $150,000 per operating day. This is going to yield a total expense or a total operating expense of $52,050,000 in year 1. Maintenance costs, so if you account for how much each type of maintenance is expected to cost, if you multiply that by the number of maintenance session schedule, we are going to get $340,000 in maintenance costs. Logistical costs, we said, are $1 million. Remember the 700,000 plus the 300,000 we spoke about earlier. And the grand total we get over here is $53,390,000 incurred to operate our plant in year 1. So this is next year. Now, what does this mean in today's value? So we're going to go back to the present value table, and we're going to find the point where the 4% meets 1, which is 1 year, and the figure we get is 0.96154. So multiplying this figure, 0.96154, by the $53,390,000 is going to yield $51,336,538. What we're saying here is the $53 million you are paying next year is actually equivalent to $51 million paid in today's money. We're accounting for the value of money depreciating over the years. We're going to go ahead and do the same exercise for year 2. Now notice the numbers are different because the number of operating days vary from year to year, and the maintenance costs also vary from year to year. So again, here we are going to multiply the total with 0.92456, which is the point where 4% on the x-axis and 2 years on the y-axis actually intersect. So this brings the number down from 52 million all the way down to $48,113,905. We're going to do the same for year 3, year 4, year 5, and year 6. And then calculating the grand total of total service costs, we are going to get $340,440,000 in nominal values, but $274,763,980 in actual present value. Now, one thing here, it is interesting to compare the figure we saw in year 2 and the figure we saw in year 6. Okay, so year 2 and year 6 both had the same total, which was $52,040,000. But when discounted, the figures actually are now showing $48 million in year 2 and just $41 million in year 6. A full $7 million less, which goes to illustrate the importance of calculating all figures at present value. Also, if we just look at the total expenses incurred, the $314 million actually accounts to just $274 million in today's value. Now, this is significant. This is $40 million here. It's significant because it's going to mean the difference between me actually going ahead with the investment or saying, you know what, this is actually an extra $40 million, which is close to 12 or 13% of my investment, and that could eat up all your profits, and therefore the investment is not going to be a good one. So this figure then, the $274,763,980 is exactly the figure that we are going to plug into our equation in order to calculate the total cost of ownership. Again, remember, this is discounted at 4% from years 1 to 6. And of course, we see now that our original $35 million investment, so the acquisition cost was $35 million for this asset, but my actual total cost of ownership is almost 11 times more than that, or actually 9 times more than that, at $302,164,624. So having calculated the TCO, we are now in a much better position to make a decision on this investment. So there you have it, how to calculate TCO. If you have any questions, please go ahead and write them down in the chat box. Otherwise, thank you so much for attending, and hopefully you can make the best out of this explanation on calculating the TCO.
Meirc.com